All right, so what are we talking about here today?
Derivatives.
Derivatives, okay. How long do I have? What do you want me to take, a couple hours or so?
3 minutes.
3 minutes? All right, hit the timer. Derivatives are a financial asset or a financial liability. They're a contract between two parties. And essentially, these contracts derive their value based on an underlying asset. The one aspect of derivatives is that they're highly leveraged. Common examples of derivatives are futures, forwards, swaps, and options. Companies enter derivatives for risk mitigation purposes primarily, but they can also enter them for speculative purposes or to facilitate transactions with customers. Banks do that. It's being an intermediary. Derivatives are governed by ASC Topic 815. What does that say in a nutshell? Derivatives are on the balance sheet at fair value with changes in fair value through earnings unless it's part of a valid hedging relationship. ASC Topic 815 says derivatives have three characteristics. Number one, it has an underlying and a notional amount. What is the underlying? Well, that is the asset, the underlying asset. So if it was an oil future, it's the price of oil would be the underlying. The notional amount is essentially the number of barrels or the number of units. The second characteristic, it has no initial net investment or a smaller net investment than would otherwise be required to gain the same exposure. This is the aspect of leverage. And third, derivatives have net settlement capabilities. Either it's in the contract by itself, net settlement is allowed, or the contract can be sold via an exchange, and so it has a market mechanism for net settlement. Any contract that meets those three characteristics is a derivative unless it's part of a valid scope exception. And there are several scope exceptions in ASC Topic 815 that I suggest you check out, because if it's scoped out, then you don't have to do derivatives accounting. A common one is normal purchases, normal sales exception. An example of that would be Shell buying that oil future. It needs it because it sells gasoline. The last thing we have to talk about in a minute or less is embedded derivatives. Embedded derivatives are when a derivative is embedded in another contract. It might be a bond or a debt instrument. It might be a lease. It might be a revenue contract. Basically, what we need to determine is, do we need to separate it out, bifurcate the embedded derivative out? The rules for that are simple. Number one, is the whole contract at fair value through the earnings? If so, don't worry about it because the derivative is too. Number two, does that thing meet the definition of a derivative? Does it meet the three characteristics? If so, then we move on. If not, don't worry about it because it's not a derivative. Third, and this is the most important thing, is the underlying clearly and closely related to the host contract? If it is, you don't have to bifurcate it because it's supposed to be there. Common examples would be like a bond. If the underlying relates to creditworthiness, interest, or inflation, you're probably good. If it doesn't, if it's related to revenue or foreign exchange, then you have an embedded derivative that needs to be bifurcated. For a more thorough coverage of derivatives, I suggest you check out our e-learning on the revolution. That is impossible. Normally I do it about four hours in the classroom, but